Namaskar. In session 30, we will discuss about the movement of exchange rate in India. After the determination of market determination of exchange rate regime, how the rupee develop over the year, what are the how the rupee exchange rate fluctuate over the year. The fluctuation leads to understand because while designing a exchange rate policy, a exchange rate system, an exchange rate intervention process, you have to understand the ideal value of the rupee, whether rupee is tracking its fundamental value or rupee is appreciating or depreciating, you have to understand, and then only you can design what is called a reserve management policy. So, movements of rupee over the year as per, along with the reform measure, how it is developed, we discuss in this session. To understand this, we have to understand the purchasing power, purchase and sales of foreign exchange by Indians are strictly controlled. Earlier, if you see prior to reform, because the exchange rate policy developed along with the reform in foreign exchange market. So, prior to reform, particularly prior to 1991, the purchase and sale of foreign currency or foreign security by Indian were strictly controlled. So, we can as you and me as individual or a businessman or a company cannot purchase and sell foreign security without any kind of what is called permission from the RBI, permission from the government of India. However, in 1978, if you we have discussed earlier in our foreign exchange reform measure in India, that time we discussed that in 1978 the RBI allowed the banks to undertake intraday trading in foreign exchange, and this for us marks the beginning of the foreign exchange market in India. 1978 first time RBI allowed the bank for intraday trading in foreign exchange. That time we can mention that the beginning of the market determined exchange rate system started or beginning of the foreign exchange market started. However, only intraday trading, there is a lot of control measure was there. We cannot invest in current foreign exchange asset, individual cannot keep foreign exchange, company cannot keep foreign exchange, banks have to declare the foreign exchange reserve, everything was controlled. Only intraday trading was trading for the bankers, RBI allowed to liberalize the policy. As an opportunity, banks to make profit, because intraday movement gives some kind of profit to bank. So, as the opportunity to make profit, the major banks, primarily few banks started trading in foreign currency, they gave two-way quotation and against rupee as well as cross currency, and gradually the trading value began to increase and some way profit arise because of the intraday trading measure. In 1970, this continued till from 1978 to 1992, and exchange rate regime was characterized by daily announcement by the RBI what should be the exchange rate for different currency, and the authorized dealer, that is banks were banks were doing the merchant transaction as per the declared level of declared rate of RBI. So, these are the control regime, there is no development of rupee, there is no development external value of the rupee. So, in a control regime there is no market determination of exchange rate, and exchange rate was, there is no exchange rate movement at all. On daily basis, announcement was given by the RBI for buying and selling of foreign currency, and authorized dealers were doing the same transaction basis, only intraday position they were making some little bit of fee income earning, they were doing that. So, there is no development of Indian rupee up to 92. So, but what is the movement of foreign currency that time? If you see 1970 to 1991, I have taken the data of average data of US dollar, pound sterling and Japanese yen. You see Japanese yen is 100 as per the guideline, 100 2 in 100 multiple, but others are in individual currency wise. 1772, 1992 I have given the data to you. You see the exchange rate movement in foreign currency market. Pound sterling, there was a dollar was rupee was depreciating and against pound sterling, against Japanese yen, against US dollar. A depreciation or appreciation not because of market fundamental, there is no market of foreign exchange. The depreciation appreciation was there because of devaluation or revaluation of currency. The devaluation and revaluation of currency were decided by the RBI, by the government of India. If you see 1972 to 1992, the exchange rate rupee was depreciating over the year and against pound sterling, against US dollar, against Japanese yen. And this depreciation was primarily because of fundamentals of rupee, RBI and government of India deciding what should be the actual value of the rupee. Till 92 there was no market determined exchange rate system in India. The value of the INR, that is Indian rupee, was changing as per the direct intervention by RBI. There was no concept of appreciation or depreciation of INR since there was no market for foreign currency. The INR value, the rupee value was changing because of planned devaluation against US dollar and pound sterling and Japanese yen. RBI, the government of India were deciding every year, once or twice in a year there was a devaluation rupee against pound sterling, against US dollar, against Japanese yen to take care of the export and import requirement. Devaluation was undertaken to make the export attractive against our competitor currency. And that was the fundamental reason that the rupee value was depreciating over the year, because the government of India, the RBI wanted to make our export more attractive in nature. So, after 92 the exchange rate market started. We have adopted the policy of liberalization. The government of India progressed to liberalize the foreign exchange market after 92. The liberalized exchange rate regime system was introduced starting with the dual exchange rate system. If you remember that from 92 to 94 there was a dual exchange rate system. Under the dual exchange rate system, exporters were allowed to keep a part of the foreign exchange earning in their own in the US dollar or any other currency, in part and second remaining part they were converting into as per the RBI declared exchange rate. As per the dual exchange rate system, exporters were allowed to convert part of their export proceed as per the market line, a part of the export proceeds as per the RBI declared exchange rate. Until 94 this dual exchange rate system was continuing, a part together RBI was deciding the value of the rupee, at the same time market also deciding the value of the rupee, and two system was continuing till 94. For this reason it was called dual exchange rate system. And during the dual exchange rate system, there was some development of rupee and there was some movements in rupee, and there was exchange rate market developed slowly. If you see the rupee value during that time, I have taken the monthly data from 92 to 92 to 93, nearly 2 years data I have taken into account. You see US dollar in blue line was around 35 rupees, 34, 32 rupees and moving like that. Similarly, pound sterling was also moving like this, there was declining in pound sterling value, rupee was appreciated against pound sterling value. However, rupee was remaining at 32, 33 against US dollar, and Japanese yen, rupee was depreciating against Japanese yen. And this indicates the US dollar has become major currency for us, and our focus was on US dollar, and earlier the pound sterling as a focus area of currency had declined over the year, and this led to this 92 to 93, 94 the dual exchange rate system tried to address the value of the rupee, and significantly the exchange rate market developed, and there was a dual exchange rate system tried to identify the true value of rupee. At the same time, RBI was declaring the exchange rate and market also declaring the exchange rate, and this dual exchange system tried to develop the actual value of the rupee. And after 94 dual exchange rate system abolished and system of abandoned and unified exchange rate system started. Current account was liberalized, and the convergence of dual exchange rate and unification of exchange rate lead to market determined exchange rate regime for rupee. So, the current account the Government of India completely liberalized the current account and adopted the policy of current account convertibility as per the IMF agreement. So, as per the current account as we discussed earlier, current account is a merchandise export import account, the invisible trade account, the trade and tourism side, transportation side, dividend interest payment side, insurance premium side, salary compensation to employee side, family living expenses, and all these are the part of the current account where day to day transaction take place. This current account has been liberalized in 1993-94 and completely liberalized. There is no control on current account and there is no control on the part of the RBI on exchange rate. And RBI did not declare any kind of exchange rate for market. RBI rate was indicative in nature, it was the market determined exchange rate, all transaction rate taken place after 94, and this 94 was a significant year for Indian foreign exchange market, because the rupee started finding its own value for against different currency. Rupee, there is no control on rupee movement as per the current account convertibility is there. However, capital account convertibility till the Government of India, the RBI control, and there is no capital movements were controlled as per the policy of the Government of India, as per the policy of the RBI. However, current account there are significant liberalizations were there, and RBI there is not controlling the current account transaction. And if you see the development process, if you see the exchange rate movement after 94-95, I have taken up to 95 monthly data, average value of US dollar, pound sterling and Japanese yen. I have taken here 94 January to December 95. So, it is nearly 2 years data here, 24 month data, and see the movement of Indian currency, India rupee. Here rupee Japanese yen appreciating, rupee depreciating against Japanese yen. Similarly, against pound sterling, rupee was depreciating. A rupee first time covered the 50 rupees per pound sterling in July 95. Against US dollar, if you see the green line, the blue line of US dollar, the rupee remains stagnant against US dollar somewhere near 34-33, and against July 95, rupee started depreciating against US dollar, and first time it cost 35 rupees, and this indicates that Indian rupee finding its own value against a major currency of the world because of the current account convertibility. Current account convertibility provides some kind of market determining exchange rate for rupee. And after 94-95, that after the current account convertibility, Government of India established 3 different committees. The first committee was Sodhani committee, very important for the foreign exchange market. The Sodhani committee identified different area for more market determined exchange rate, and the Sodhani committee identified how to develop the foreign exchange market, how to provide more opportunity to bankers, how to provide new product to the foreign exchange market, what kind of new requirements foreign exchange market should have, so that there should be risk management practices developed along with the development of market determined exchange rate regime. So, Sodhani committee identified different area for liberalization of foreign exchange market. As per the recommendation Sodhani committee, if you see the actual guideline, actual recommendation, you will find that the Sodhani committee recommended to Government of India, to the RBI, there should be freedom to initiate trading position in overseas market. So, banks should be allowed to trade in foreign currency in overseas market. There is a primary requirement, because it is the banking sector which actually provides the foreign currency, which actually interact with the requirement of individual, requirement of business group for foreign currency, and they should be allowed to trade in foreign currency in overseas market. Freedom to borrow or invest in funds in the overseas market, that should be bank should be given the freedom to borrow and invest in foreign currency market. Freedom to determine the interest rate on foreign currency non-resident deposit. The significant part of foreign exchange reserve is coming from invisible for non-resident deposit. So, banks should be given the freedom to decide the interest rate on FCNR deposit. Similarly, since we have adopted the market determined exchange rate regime, there will be risks in foreign exchange. The fluctuation of foreign exchange is a risk both for the exporter, importer and all other individual who generally transact in foreign currency. So, there should be risk management product to absorb this risk, and there should be product to design should be given to the banker in the form of derivative product for asset liability management in foreign currency. The corporate also should be given the freedom to hedge their unanticipated exposure, because corporate generally handle the export import side. So, they have the foreign their earning, their liability and foreign currency. In any fluctuation in foreign currency is a risk for them. They should be allowed to hedge their unanticipated risks. Any kind of unanticipated risk should in exposure in foreign currency by the corporate, they should hedge it and they should be allowed to hedge it. That is a requirement for them. Sodhani committee recommended this. Similarly, bank can offer cross currency option on back to back basis to corporate, because corporate asset liability denominated in not only one currency, but multiple currency. So, the cross currency options back to back basis should be given to the banker to offer to the corporate. Similarly, framing a comprehensive risk management guideline for bank required now, because banks are now handling the market determined exchange rate policy. So, there should be comprehensive risk management guideline, particularly in exchange rate side for the banking sector. They should the RBI should design the risk management guideline for the banking sector. That was the recommendation of the Sodhani committee. Similarly, adopting Basel II committee recommendation computing foreign exchange position, limits and capital backing position for foreign exchange open position, because banks are now exposed to foreign exchange volatility and banks are handling the foreign exchange side. Whenever there is open position, there will be risk for the bank, and banks would have sufficient capital to absorb this risk. I say that the risks of the foreign currency open position, foreign currency open position should be backed by actual capital, and that capital requirement decided by the Basel committee, and this Basel committee recommendation for the risk management in foreign currency area should be adopted by the bank as per the requirement of the Sodhani committee. If you analyze the Sodhani committee recommendation and the RBI reform the foreign exchange market, as per the recommendation RBI the ceiling on 15 crores overnight borrowing limit, in open position was removed in 96. Currently, banks are deciding their own overnight position according to the capital base. The capital requirement and the foreign exchange risks both are now aligned together as per the recommendation of Sodhani committee. Similarly, the RBI also allow the bankers the merchant transaction dealing expertise, merchant transaction for the foreign exchange side. RBI allow the merchant banker, the merchant trader to trade in foreign currency and develop the risk management practices and handle the open position. Similarly, the banks are permitted to fix their own gap limit subject to daily ceiling. What is the gap limit for day basis? That should be designed by the banker themselves, and they should have a day limit as per the overall position. Permission granted to bank to initiate cross currency position overseas on the basis of infrastructure facility, capability and experiences. Each bank can decide what should be the level of cross currency position they should have in overseas market. That is also accommodated by RBI, recommended by the Sodhani committee and accepted by the RBI. In order to impart depth and liquidity to forward market, because forward markets develop develop over the year as per the recommendation of Sodhani committee, because forward market provide what is called risk management product for the corporate, for the bank, and over the year the forward market developed, but there was no depth in forward market, there was no liquidity in forward market, and Sodhani committee has recommended a significant guideline how to open the debt market for the forward market for new banks, financial institutions, so that there will be more liquidity in the depth in forward market. That also asserted by the RBI, and RBI allow new banks, financial institution, authorized dealer for trading in for providing the forward market operation to corporate. Similarly, the number of market participants increased because of the new recommendation, and RBI accepted this, and new banks like IDBI Bank, ICICI Bank, and also many financial institutions, they were given the permission to trade in foreign currency. This is the recommendation of Sodhani committee. Similarly, if you see other reform measures, Sodhani committee provided that market intervention by RBI should be there on should be there, but that should be limited intervention should be there, because the RBI intervention in spot and forward market not good. It intervenes both for spot and forward market. Market intervention by RBI no longer on quote two-way price on a daily basis. It intervenes in both spot and forward market, because whenever there is a requirement for the intervention on the part of RBI, this should intervene both forward market and spot market together. Banks are free to determine the interest rate and liquid maturity on FCNR BA account. As per the Sodhani committee recommendation, RBI accepted this. Exporters are allowed to retain 50% of their export earning in foreign currency account, EFC account, and there is no requirement for them to convert the foreign currency immediately. Similarly, interbank borrowing is exempted from SLR requirement, for CRR requirement, and this has been accepted by the RBI, and that significant part of the money released because of there is no requirement for CRR, SLR for interbank forex borrowing. That also part of the Sodhani committee recommendation. As per the Sodhani committee recommendation, there was further development in the foreign exchange market, there was more depth in forward market, there was more participant in the forward market, foreign exchange market, and there was more freedom on the part of the bank to trade in foreign currency market. This has given a new impetus in exchange rate system. If you see, I have given the data for month wise data from 96 January to 97 December, 2 years data, how because of the Sodhani committee how rupee has developed over the year. You see rupee little bit depreciated because of the more over the year, and remains stable. There is no significant depreciation against dollar. Similarly, against pound sterling also there is no significant development in case depreciation rupee because of the Sodhani committee recommendation. Rupee got its own fundamental value because there is more participant in the foreign exchange market, and this rupee discover its own value over the year. If there is the reform measure is not adequate, reform measure is not segmented in nature, there will be more affable in the foreign exchange market. This kind of affables were there in many emerging economy when they suddenly open up the current account. However, in case of current account, in case of India, despite current account depreciation, our affables in foreign exchange market is not there. Rupee has not depreciated significantly against any particular currency, because the reform measure, the opening of the current account accompanied with many kind of reform in foreign exchange market for the development of product side, for the development of market participant, for the liberalization of FI, FDI investment. So, this has not significantly affect our in foreign exchange market. Similarly, if you see another committee recommendation was the Tarapore committee. Tarapore committee was appointed by RBI along with the government of India in 97 for the further comprehensive measure, to provide comprehensive measure for the what is called foreign exchange market development side. Tarapore committee primarily given the recommendation in the for the further development in towards what is called the FDI investment, FI investment, joint venture side, foreign exchange debt market, and also foreign exchange risk management side, and there is a mutual fund side, how they were to be included in the foreign exchange market. There was a primary recommendation of the Tarapore committee. If you see the Tarapore committee on capital account convertibility in 97 had recommended a comprehensive measure for foreign exchange market. This is because up to 96, 97 Indian rupee has identified its position or value as per the current account convertibility concern, but Indian rupee and Indian investor should also be allowed to invest in foreign exchange, foreign asset. That requirement requires what is called liberalization in capital account concern. The capital account was controlled significantly till 96-97. However, the Tarapore committee recommended that capital account should be progressively liberalized so as to allow foreign direct investment, foreign portfolio investment, joint venture, wholly owned subsidiary, abroad project, export project related export, opening of the Indian corporate office by Indian company, allowing the acceptance of credit for export, for allowing more FI to come in the debt market, for allowing more equity participation, equity investment in by FI. These are the some recommendation on the part of the capital account convertibility for the as per the Tarapore committee. The Tarapore committee also recommended that along with the capital account liberalization, there should be improvement in risk management practices, there should be more risk management product in the foreign currency market in the form of interest rate swap, foreign futures market, derivative product that requires that because rupee is fluctuating, rupee is as per the market determination exchange rate, this fluctuation will be there, this will not should not affect our foreign exchange stability side. So, recommendation for registering Indian fund manager, particularly the mutual fund to invest in overseas market as per the SEBI guideline, that also part of the recommendation by the Tarapore committee. If you see the Tarapore committee recommendation, there has been some significant reform measure Government of India and the RBI have initiated. Now, the RBI has allowed Indian joint venture wholly owned subsidiary to invest 50 million in abroad. Similarly, removal of existing requirement for repatriation of amount of investment by way of dividend within 5 years. That a repatriation in dividend should not be there, any time they can the dividend can be repatriated by the investor. Similarly, allowing exporter, exchange earner to keep 100% of their forex earning in foreign exchange in foreign currency account. The exporter, the exchange earner should not can keep the foreign exchange earning 100% in foreign currency account, permitting the individual resident to invest in financial asset abroad up to 25,000, and gradually this has been increased to 51 lakh recently. Similarly, the mutual fund to invest in security abroad within the overall limit of 500 million in different phases. RBI also allow the mutual fund investor to invest up to 500 million in phase manner in abroad security. This significant liberalization is, if you consider this is a significant liberalization as per the capital account convertibility concern. The reform measure further initiated by the bank given more freedom in foreign currency borrowing, foreign currency deployment of funds. Similarly, the foreign institutional investor significantly allow in portfolio investment side, they also allow repatriate the portfolio as per the RBI. There is no requirement for the RBI guideline, anytime can they repatriate the portfolio. Similarly, all FIs, non-resident Indians and foreign banks fully access to forward cover of their asset, because they were allowed to cover up their open position in their HNE because of in foreign currency assets. Similarly, the banks and financial institutions were allowed to participate in gold market abroad. Similarly, withdrawing the Reserve Bank from playing a role of government merchant banker, the government as a Reserve Bank as a merchant banker for the government, this guideline has been withdrawn, and RBI also participated in the foreign exchange market as a bankers, not as a controller of foreign exchange market, not as a players in the foreign exchange market. Similarly, If you see as per the capital account convertibility, as per the recommendation of the Tarapore committee, there has been significant development in the foreign exchange market. If you see the foreign exchange market over the year from after the recommendation in 97, 98 to 99, how the rupee developed, if you can analyze this. You see the January 98 to December 99, 2 years monthly data I have given. This during this period, the recommendation of Tarapore committee was implemented. Many policy measures have been initiated as per the recommendation. This recommendation policy measure has given new impetus to rupee to identify its own value. This dollar, US dollar, pound sterling and Japanese yen, if you see the US dollar, despite the reform measure, US dollar remains stable against rupee. Rupee remains stable against US dollar despite reform measure. Similarly, pound sterling also remains stable during that time. There was a little bit depreciation of pound sterling or appreciation rupee was there. Japanese yen also remains stable. So, the reform measure has given more stability to rupee. There is no fluctuation or significant fluctuation or volatility in rupee against pound sterling, against US dollar, against Japanese yen. These are three major currencies in the world, and this stability of rupee indicates that our reform measure has been consolidated over the year, and with the opening of the current account, with the gradual reform in the capital account, there is no such kind of high volatility in Indian rupee. This is a remarkable achievement as far as the foreign exchange market development concerned. Similarly, if you see after 2000, after the reforms initiated as per the Tarapore committee, after 2000, there are 2000 to 2001, these 2 years also the data January 2000 to December 2001, 2 year data, you see there is a little bit depreciation of rupee is there, but this depreciation is as per the market requirement, as per the purchasing power of the rupee, and this depreciation required because other currency has depreciated again, other currency particularly the competitor currency has depreciated against US dollar. This depreciation requirement is there because to make a rupee more attractive for exporter. However, there is no significant volatility in the rupee value against dollar, against pound sterling and Japanese yen. This is a remarkable achievement on the part of the reformers, where they have reformed the capital account and also current account. Similarly, in 2002-3 onwards also, if you see that also rupee during this period 2000 January 2002 to December 2003, the 2 years period, rupee appreciated against dollar. Similarly, against pound sterling little bit, against Japanese yen also. This is the first time in the achievement of last 10 years of reform measure, rupee appreciated against pound sterling, against Japanese yen, against US dollar. This depreciation was affected our export, and realizing this because during this period there was significant inflow of foreign currency in the form of FI, in the form of FDI into India. This inflow has appreciated domestic rupee, and because of this reason rupee appreciated over the last January, some extent during the March 2002 to till November 2003, that 7 to 8 month period, rupee was appreciated. This is a concern, this was a very large concern on the part of the exporter, because when rupee appreciated, export will be more dearer to exporter. This will affect our export earning, and by realizing this, RBI intervened in the foreign currency market, and after that rupee started depreciating against US dollar, because against our competitor currency rupee was appreciating, against our pound sterling, US dollar and Japanese yen rupee was appreciating. This appreciation of the rupee beyond the fundamentals value is a matter of concern, and this realized by our RBI and the government of India, and they intervene in the foreign exchange market to arrest the appreciation of rupee. If you see Recent reform measure, there has been significant reform measure recently. The RBI, the Government of India has further liberalized the foreign exchange market, particularly the current capital account side. The capital account side liberalization was undertaken as two parts. One part is called the part of the FDI side, another part is called toward the FI side. In FDI side, the MRTP Act was further liberalized, MRTP was abolished, Competition Commission Act was introduced, many industry, company sector, joint venture, subsidiary, there was a liberalization measures were introduced, foreigners were allowed to participate in foreign direct investment side, many resources or industrial segment there has been significant liberalization for foreign direct investment side. Overseas and FI side, further liberalization were there for the FI to invest in equity, debt market, and overseas funds are allowed to hedge their entire foreign exchange exposure arranging for investing in Indian equity market. Board of the individual banks were allowed to decide how much foreign exchange investment abroad should be there. Indian residents are allowed to open domestic account to deposit foreign currency obtained through payment received for the services export, a services side, honorarium side, gift side, and also travelling side. There is no ceiling on the amount that may be kept in such account. Similarly, Indian firms can borrow up to 50 million from global sources without government approval and prepay foreign loan ahead of scheduled. Repatriable status accorded to all resident banks deposit except balance in NRO account. So, these are the measures recently undertaken by the Government of India, by the RBI. Similarly, if you see further reform measure like for NRI capital transfer for NRI up to $1 lakh, $1 lakh US out of sale of immovable property, as also inheritance and legacy has been permitted. The NRI capital transfer is allowed up to $1 lakh. Limit for Indian direct investment under the automatic route has been doubled to $100 million. Corporate have been accorded greater freedom to raise and prepay foreign currency borrowing. Corporate have also been accorded greater freedom to raise short-term supplier, short-term buyers credit for import. Similarly, FI have been allowed to trade in exchange traded derivatives in India. Similarly, corporations are free to rebook, cancel foreign exchange forward contract. Rupee based currency option future has been introduced. Interest rates currency swap has been introduced recently. And these are the measure on the part of capital account liberalization. So, to allow the more inflow of foreign currency into India. At the same time, development of foreign exchange market for the risk management practices, and these two together only give stability to Indian rupee, and Indian rupee can get a market value as per its fundamentals. This has led to development of foreign exchange market further. If you see recent year, the movement of Indian rupee against pound sterling, dollar and Japanese yen, there has been significant depreciation of rupee against pound sterling after 2006. The depreciation primarily due to the recession in the world market. Similarly, if you see the against the dollar, rupee was fluctuating, and the rupee fluctuation is significant, and rupee into significant after 2008. There has been significant depreciation of rupee after 2008. There has been withdrawal of FI investment, there has been reduction of forex earning in the form of export, invisible earning has been reduced, and also the inflow of foreign currency has reduced, and this has depreciated rupee further. A rupee has crossed the beyond 50, and this is against of the fundamental value of the rupee, and because of this reason imports were more costly for the Indian side, and however export was not picking up, and this has created a problem for the management of Indian rupee side, and RBI further liberalized the foreign currency market for the allowing more FDI, more FI investment in debt and equity market for foreigners. And if you see the Japanese yen also, there has been depreciation is there against in rupee was depreciated against Japanese yen also, and this has affected our export, our foreign currency management side, and foreign currency management need to be addressed further, because we have to identify the depreciation rupee, whether it is linked to our fundamentals or is a speculative in nature. If it is linked to our fundamental, you have to reform the fundamentals further by moving towards more convertibility of rupee. Similarly, if it is linked to speculative in nature, you have to address the speculative links in rupee, because speculation there is no requirement of direct intervention in the market by purchasing or selling of US dollar, because there is no end to speculation. Speculation has to be addressed fundamentally. The fundamental part of speculation to identify whether there is a hoarding of dollars by bankers, by exporter or any other foreign currency traders, because the hoarding of dollar is there. This means this for getting further appreciation of depreciation rupee is against the fundamental value of the rupee. So, we have to take into account identify what is the fundamental value of rupee tracking the fundamental value. If rupee is depreciating beyond the fundamental value, then there is a requirement of reform. While deciding the reform measure, you have to see whether the requirements are there for further mobilization capital account or to address the issue of speculation in foreign currency market. The primary thing you have to decide, the regulator should decide before intervening in the foreign exchange market. Then question is here, which are the factors that affect the fundamental value of the rupee? As we discussed earlier, the fundamental value of the rupee decided by the export import, our current account deficit or current account surplus, because when export import current account deficit is there, rupee may get their value, current account deficit is there, rupee may depreciate further. Similarly, when you discuss about fiscal policy side, fiscal policy also affects the value of the rupee. Fiscal policy in the form of taxation, high corporate tax, fiscal policy in the form of excessive government borrowing, fiscal policy in the form of excessive high interest rate in the economy, that also affect the fundamental value of the rupee. Similarly, inflation also affects the fundamental value of the rupee. Interest rate through the interest rate parity hypothesis affect the fundamental value of the rupee. Similarly, high money supply through inflation also affect the value of the rupee. Central bank intervention, whether central bank intervening in the market, for what reason they are intervening, that also affect the value of the rupee. Similarly, speculation also affect the value of the rupee. Besides these, there may be some subjective factor, subjective in the form of complexity of international political environment, societal and economic infrastructure, random random factor, particularly political, economic and social events, all this also affect the fundamental value of the rupee. I have analyzed this policy against the rupee, and if you see, I have done it here. What is the rupee value against the current account? The current account is increasing since 92-93. I have taken the 20 years data here from 92-93 onwards till 2011-12, and I have taken here the exchange rate against the US dollar value, and also current account deficit or surplus. Deficit here, negative part is deficit. What is the movement of US dollar, Indian rupee against US dollar along with the current account? If you see, the red part is current account deficit, and the blue part is here US dollar. So, here if you see, the US dollar rupee is depreciating, fluctuating against US dollar, or similarly if you see long term pattern depreciating against US dollar. However, if you see the current account deficit is increasing over the year. So, there is a negative relation, or we can tell there is a positive relation, depreciation of rupee and increase in current account deficit. So, when current account deficit is more, rupee is depreciating. So, because this is a fundamental relation is that when there is more current account deficit, there is more demand for US dollar against rupee, and rupee definitely depreciate. Now, this is a fundamental relation. Similarly, I have identified the inflation and exchange rate. When there is more inflation is there, the value of the export earning, import, export. If you see the inflation and US dollar and exchange rate, when there is more inflation, real interest parity hypothesis works here, because the value of the rupee, actual value of the rupee will decline because of high inflation, and when actual value of the rupee decline, the rupee value will depreciate against US dollar or any other foreign currency. The fundamental is here also, if you see the graph, US dollar is blue color, red dollar is REER. I have taken the REER here, real effective exchange rate. REER inflation I have taken, and if you see over the year how the development take place with the US dollar is appreciating against rupee, US dollar appreciating against rupee or rupee depreciating with the inflation is increasing, with the when inflation is increasing, rupee value is depreciating. Similarly, I have taken into account here broad money supply and other thing. There also same thing happened. The broad money supply is increasing, and broad money supply also increasing, and when broad money supply is increasing from 19% here, broad money supply is increasing, money supply is increasing, rupee value also depreciating, Similarly, here I have taken into account other component like that your call rate, because call rate works through what is called the call rate works through the interest rate parity hypothesis side. When call rate is increasing, there is discrepancy is there between Fed fund rate and call rate. When call rate is more inflow of dollar will be there. Over the period, call rate declining a rupee, and when the call rate is declining, the interest rate parity hypothesis, this differential interest rate is declining, rupee value will depreciate. Similarly, I have taken into account further other side of the graph also. If you see here that the REER side, real effective exchange rate and rupee value. Real effective exchange rate reflect the trade basket weighted exchange rate here, and also inflation adjusted exchange rate here. When exchange rate and against the dollar, if nominal exchange rate here dollar value is there, here real effective exchange rate like trade weighted exchange rate and inflation weighted exchange rate you have taken into account, and along with that rupee also depreciating over the year. These are the movement tracking period, how the rupee value is over the period it changes its value. This movement tells us how the Indian rupee, no doubt there has been capital account convertibility, current account convertibility, significant liberalization is capital account. However, there are macroeconomic fundamental in the form of fiscal policy, in the form of inflation, in the form of interest rate, money supply also affect the value of the rupee. And if you see INR, that is the value of the Indian rupee has been moving in tandem with the inflation rate WPI over the year. Similarly, over the year INR has been depreciated primarily due to significant current account deficit. We have current account deficit despite liberalization, we are not in a position to arrest it, and this current account deficit has been increasing over the year because of our basket composition of export import. Similarly, and this current account deficit has reduced the value of the rupee, or the value of the rupee is depreciating over the year. And similarly, real effective exchange rate tracking the fundamental value of the rupee, despite rupee depreciating, but rupee is at par with the fundamental value, because REER tracking the fundamental value of the rupee, and rupee against US dollar is moving as per the fundamental value of REER. Similarly, INR changes, and the movement in very short term interest rate in India has some fundamental relationship as per the interest rate parity hypothesis, because earlier India was a high interest rate country as compared to the US market. This interest rate discrepancy over the year has reduced, and because of this interest rate discrepancy, the interest rate parity hypothesis to some extent applicable in case of India, and the forward market tracking the value of the rupee, which tracking the value of the rupee also align with the interest rate parity, and that and reflecting the INR value in recent years. Along with that, let me complete with this session, and here we have discussed the movement of exchange rate as per the liberalization measure over the year. The liberalization measure was we have discussed the liberalization in the current account side, liberalization in capital account side, and how the value of the rupee find its own position, own value in a liberalized market, in a market determined exchange rate regime. And you can go through further references I have given to here. References are RBI annual report, various issues of RBI annual report. There you can track the reform measure of Indian foreign exchange market. Similarly, you can use the data of RBI side on handbook of statistics on Indian economy. You can plot different graph and try to find the movement of Indian rupee along with the various macroeconomic parameter. We can go through the Tarapore committee and Sodhani committee. These two reports provide basic framework for the foreign exchange market in India. And reference here model question I have prepared for you, outline various reform measure undertaking in the Indian foreign exchange market. As we have discussed, you can Sodhani committee, Tarapore committee reform measure you can discuss here, outline various factors influencing the exchange rate. Along with the reform measure, you can identify macroeconomic factor, how they are influencing the exchange rate. Third question is here, what are the factor need to be monitored so as to articulate the future direction of INR against rupee. Here identify the various factors like interest rate parity, identify inflation, exchange in you can see that export, import, invisible import, current account deficit. These are the various factors which influence the value of the rupee against the US dollar or any other currency. These are the factors need to be monitored so as to understand the direction of rupee in recent years. Thank you.